Good evening, everyone. I hope you're doing well. We've seen some pretty big moves in the precious metals market in gold and silver, gold mining stocks, and I have been advising some of you to take profit and reduce exposure. So I just wanted to go over some of the charts really quickly and show you some of the reasoning, show you how things have performed. So we're having a look at a gold chart here. Now, if we go to the daily chart, we can see that since the low on February 14th, the price of gold is up 21% and at its peak was up about 22%. But what we are seeing now is you can see the price is making so this is a daily chart. Each candle represents 1 day of trading activity. You can see the price is making a marginally higher high after a sell-off back to about 2,300. But note, we're starting to see some negative divergence on the momentum indicators. In fact, we saw it starting there on the RSI. So price making marginally higher highs, which is sometimes not very encouraging. Momentum indicators trending lower. So this is an indication that the uptrend is losing a bit of momentum, losing a bit of steam. Now, I'm not saying that gold is going to crash from here. I'm just saying that it's had a good run. In the space of 3 months, it's up nearly 22%. It makes sense to take a little bit off the table. And we'll see the same if we go to the gold mining stocks. So I'm looking at the US listed GDX, which is one of the, most of us own this one, or MNRS. Now, in that same time frame, since the 28th of February, so that's less than 3 months ago, the gold miners have gone up 43%. So they've had an excellent run. It's important to reduce exposure and take and look at this in the last what was that date there, the 24th of April. So in the last 4 weeks, again, look at that, 15%. It's had a big run. And if we draw, I mean, I wouldn't really draw an uptrend there. I don't like those slanted lines like that, those angled trend lines. I prefer previous price levels. You can see it's right near the high. We're seeing again some negative divergence on the momentum indicators. No, it's not a crazy strong sell signal here, but clearly it's had a good run. It's had an excellent run. It's probably time to reduce exposure. I generally advise up to 20% allocation to precious metals. At the moment, I'm suggesting we reduce that to roughly 15%, and then depending on the nature of your account, how much money you have. Of course, if you're listening to this video and you're not yet a client, please keep in mind I'm not allowed to give you investment advice, so this is not any advice to you. I'm just showing you what I'm doing, what my clients are doing, and you can see the run that the gold miners have had. Now, what I might do is come back to longer term charts. Well, let's look at silver first. Silver, excellent run. I mean, since the low in February, silver has gone up 45%. It's coming off a little bit tonight, but you can see it's right near the highs, up about 45% in price in 3 months. So an excellent run. Now, silver is not yet showing negative divergence on the daily, but it is very overextended, and we might argue a case that the RSI is starting to negatively diverge. But no, it's not that there's a clear sell signal yet. It's just that we've had a big run, and it makes sense to take a little bit off the table when we see this. But if we go longer term, the longer term signs are very encouraging. So this is now a 5-year chart. So this was the first high above 2000 back in August 2020. And you can see that sort of level around the 2050 mark. If you look at a longer term chart, it's closer to the 2000 level. In fact, if I draw the line there, you can see 2000, a very key psychological price barrier. It took gold about 3 years to break out from that. And you can see once it broke out, we had this tight little consolidation, a little squeezy, as the market sniper would say, and then up popped gold. And of course, we don't see too much negative divergence yet on the weekly chart. And if we go to an all-time chart, you can see, and let me just remove some of those drawings, you can see this massive cup and handle pattern. See how that looks like a cup with a little handle? That is a very bullish chart pattern, especially for it to happen on a monthly chart over, this is 2011. So this has happened over a 13-year period. But if we zoom in a little closer, we can see the breakout level around 2000, and you can see an inverse head and shoulders pattern, the left head, the left shoulder, the head, the right shoulder, and then the breakout. Normally, the target is from the neckline to the tip of the head. And you can see if I put that arrow up there, do you think it's a coincidence that we've now reached target? So you can see on the monthly chart, we've reached the target for the inverse head and shoulders breakout. It makes sense to be taking some profit here, and that's generally how most traders would measure the target. But long term, this is very bullish. All I'm suggesting is that it is possible in the short term that we see a return move to test the breakout, one more test. So maybe gold drops 10 or 15% from here, maybe it drops 10%. Maybe if it came all the way back to that line, it would be a 17% drop. At that point, I would be a very aggressive buyer. I'd be recommending we resume we go back to our full allocation, unless there's some other pretty key things happening in the market that would lead me to change my mind. So again, I'm not calling for it to crash. I'm just suggesting when you look at that monthly chart, have a look at what gold has done even since the low in November 2022. It's up 50% or 49%, and it's almost gone up in pretty much a straight line. We're probably going to see some consolidation, or at least in the short term, it's a little bit expensive. You'll see the same thing on the silver chart. If we go to the monthly chart, you can see that sort of 28.50 level was pretty key. And the same thing on silver. So this is a monthly chart. That's the 2020 high. And you can see again, inverse head and shoulders, left shoulder, head, right shoulder, breakout. Look at that huge candle in silver. You can see why I'm suggesting that silver is probably expensive in the short term. It's pretty much gone up in a straight line. And if you take the low from September of 2022, that low down there, silver has gone up 83% in price. It's had a huge move. It's important to manage risk, take a little bit of profit when it's there. I'm not saying sell all our precious metals. I'm just saying go from a 20% allocation to a 15 or 10% allocation, depending on your account, the risk level. And let's be buying when things are cheap and taking a bit of profit, selling a little bit when they go up. But the point being is for the longer term, yes, maybe silver needs to do this and come back down and test the breakout, and then I would imagine it's onward and upward from there. But these kinds of breakouts, these multi-year or decade-long breakouts are very encouraging for the long term, but just be wary of what might happen for the rest of the year. Now, we can have a quick look at platinum. And platinum, I'm going to go to a monthly chart on platinum. This was the high in 2008. The price of platinum, and for many of you, you may have noticed that I've moved you out of silver bullion or out of gold mining stocks, and I've put you into the precious metals basket fund, the ETP MPM, which mainly owns gold, but it owns a little bit of silver, some platinum and palladium. Now, platinum and palladium are very risky to buy on their own, but I'm happy for us to sit in a fund that has a little bit of an allocation to them, because have a look at how historically undervalued something like platinum is. Like, forget that spike high. There's the high from February 2008. Look at that. Platinum is still down 51% from where it was 16 years ago. And you can see it's been in this trapped in this downtrend from 2008 until about 2021. And you can see it's, again, like some of the other charts we looked at, notice how once you get the breakout, you return to test the breakout. So see, it comes up here, comes back to test the breakout, and keep in mind each of those candles is a month. So the testing of the breakout went from October 2021 to October 2022, so an entire year. Now you can see it's making some higher lows, and it's trying to bust out of this next channel that it's in. Maybe if I can just, it's a little bit messy on the chart there. Let's see if I can, I've drawn a dotted line there. Let's make that a solid line so we can just see things a little better. And you can make a case that platinum is in the process of attempting another breakout. It's made a higher high here. See the low there? The lows here were higher than the previous lows, and now this green candle is trying to bust through, but it's not out of the woods yet, and it's still got a lot of work to do. But again, these are signs that these 15-year downtrends in some of these metals are coming to an end. Let's have a quick look at palladium and have a look at that. Palladium is down 71% from where it was where it peaked in March 2022. So 2 years ago. Look at that, right down on the lows. Now, again, for most of you, buying palladium on its own is probably a bit too risky and a bit too specific of an investment, especially put into a super fund. But this is why I'm preferring the precious metals basket fund that owns gold, silver, platinum, palladium, and why I'm switching a lot of you into it, as opposed to having just silver bullion or having a heavy weighting to the gold miners. You can see the price of palladium is just ridiculously cheap, and it's way back to, like, look at that. That was the high. So platinum is the same price as it was in February 2001, 23 years ago. Now, it had a massive run up. So credit to those who were buying it in 2018, 2019, big run up. And now it's had a 70% sell off. Probably time to have a very small allocation to something like platinum. And if we go back to the gold mining stocks, let's have a look at a monthly chart. So even though gold is, so this goes back to 2011. In 2011, GDX, the gold mining company's fund, was at $62 a share. That's when gold was at 1900. Gold is $500 an ounce higher than that, which is what, about 20% higher. And have a look at the gold miners, how poorly they've performed. They are down 41%. And this is why I say the gold miners are far riskier than the metal, that in times when you're being conservative, hold gold first, physical gold, and the gold miners, especially picking individual gold mining companies, is very risky. But if we have a look at some of the trading activity now, you can see that was the 2020 high when gold first hit $2,000. Gold is now higher than that now by about 20%, and the gold miners are still way down. In fact, the gold miners are down probably 20% if you take the spike high, but let's call it 17%. Even though gold is up 20%. So you can see now you can make a case that the gold miners are extremely undervalued and extremely unloved. And that's probably correct because everyone's buying tech and AI and crypto, and it's a new world and AI is going to do everything. But again, look at what we see on the gold miners. We see a left shoulder, a head, a right shoulder. It's an inverse head and shoulders pattern with a breakout. We're now in our second candle of the breakout. So again, what I'm saying is that in the short term, the gold miners, like I showed on the daily chart, in the short term, they're expensive, but long term, they're forming some breakouts, and these are encouraging signs for precious metals. And it should also be a warning sign to central banks that the inflation problem is not solved, and I've talked about that in many videos. And if we have a quick look at the price of copper, if we go to a 5-year chart. Now, copper is selling off this week. It did make so that's a new all-time record high for the price of copper, and the price of copper since February, much like silver and gold, because someone's going to say, well, not anyone watching this video, but some of the other analysts that are anti-gold or don't think gold's a good investment, they're going to say, well, gold's just going up because of, geopolitical tensions, like what's happening with Russia, Ukraine, what's happening with Israel, Palestine. Or they're going to say, well, central banks are buying gold. Well, I'll tell you what, central banks are not buying copper. Copper is an industrial metal. So why is copper up 40%? It's gone up a lot more than gold. Now you can see some of the breakout patterns I've drawn there. Again, there's a falling wedge pattern. Once you get the breakout, it runs along the roof to test the breakout, and then up she goes, big pop. Now this is probably going to pull back a little bit as well. It's probably a bit overdone. I would suggest that it's a likely scenario would be to come back to test this previous key high. So maybe we're going to see copper do this as well. And if I can draw the arrow, which doesn't seem to want to draw, there we go. That would be something you'd expect to see if you were looking at textbook charting. We'd expect to see something like that. So a little bit, and you can see too, I've shown some of these. I showed you on gold and silver some of the divergence signals. You can see copper, as copper was trending up and making higher highs, the MACD, the RSI, the momentum indicators were trending lower, and that's a sign that a sell-off was coming. Note how it was in this uptrend. Once it breaks the uptrend, it comes back, returns to the scene of the crime to test it, and then bam, big sell-off from there. And that sell-off is about 28%. You can see it time and time again. And then this is just the mirror of that. This time you're in a falling wedge. You break out from the wedge, you return to the scene of crime, you test, and then pop. We're probably going to come back and test. So again, just to summarize, I'm not calling for a crash in gold and silver. I'm just suggesting that they're likely expensive in the short term, and that it makes sense to manage risk, take a bit of profit, and allocate to other areas that are undervalued. If you'd like to talk more about precious metals or anything else that's going on in the markets, please do feel free to reach out, and I'll leave it there. Thank you very much.